So, Elevance Health just dropped its latest earnings report. And honestly, the numbers tell a really fascinating story. And this isn't just about one company's balance sheet. No, this is actually a peek into where the entire American healthcare system is heading. So, let's break it all down.
Okay, so you hear the official line from the CEO, Gail Boudreaux, talking about disciplined execution. You know, that's corporate speak for everything's fine, this is all part of the plan. But what exactly is the plan? That's the real billion-dollar question we're going to dig into today.
First things first, let's just try to wrap our heads around the sheer scale we're talking about here. $50.1 billion. And that's not for a year, that's their operating revenue for one single quarter. That number alone just shows you what a massive, massive player Elevance is in our healthcare system.
All right, let's get into the Q3 results. And this is where the real puzzle starts to take shape. Because the numbers tell this weird story of both growth and pressure at the exact same time, which, sounds kind of contradictory. Let's dig in. Okay, before we hit the numbers, a super quick definition of two key terms. Operating revenue, that's just all the cash coming in the front door. Operating gain, that's the profit, what's actually left after you pay all the bills. Simple enough, right? Now let's see what those two numbers look like.
And boom, here it is. This is the whole mystery of the quarter right here on this one slide. Look at that top line. Operating revenue is up a very healthy 12%. Awesome, more money is coming in. But then, whoa, look at the bottom line. The profit, the operating gain, is down a shocking 45%. So how on earth is that possible? What is going on here?
So what gives? How can you be bringing in more money but end up with way less profit? Well, it really boils down to two big things. Medical costs are going up, and the company is pouring tons of money into some massive new investments. To really get it, we've got to look at the two different sides of Elevance's business.
First up, let's talk about the part of the business we're all familiar with, health benefits. I mean, this is your classic health insurance. It's the foundation of the whole company, but it's also where things are getting a little shaky.
Yeah, you've definitely heard of these brands, right? Anthem, WellPoint. This is that part of the business. It's an absolute giant, covering over 45 million people. It is the bedrock of the entire company.
And as you can see, even in this traditional segment, the money coming in is still climbing. A solid 10% jump up to $42.2 billion. So again, we ask the question, if they're making more money, what's the problem? Well, it's all about where that money is going.
So here's the breakdown in a nutshell. The good news, $4 billion in new revenue. The challenge, the profit they made from that revenue just fell off a cliff, down a staggering 63%. The company says it's because of higher medical costs and big investments in things like tech. And this is all happening while their total number of members actually dipped a tiny bit. They are really feeling the squeeze here.
But that's only half the story. Now we have to talk about the other side of the business, Carelon. So if the health benefits division is the old guard, Carelon is the new, high-octane growth engine that's supposed to power the company into the future.
So you're probably asking, what in the world is Carelon? Well, think of it this way. It's not the insurance side. It's the health services side. They're the ones managing pharmacy benefits, providing home health services, and rolling out all sorts of high-tech clinical solutions. Basically, they're getting into the business of providing the care, not just paying for it.
Now, this is where it gets really, really interesting. Remember that 10% growth on the insurance side? Well, Carelon's revenue just exploded, jumping 33% in a single year. And a lot of that growth is coming from them buying up other companies in hot areas like specialty pharmacy and home health.
So the story for Carelon is all about growth. Growth, growth. Revenue is up $4.5 billion. But, and you're probably sensing a theme here, the profit is down a little bit. And why? You guessed it. It's those massive investments they're making to stitch all these new companies together and build out the tech to handle all that new business. They're spending a ton of money to get bigger, faster.
Okay, let's just pause for a second. We've got one massive, slower-growing business that's feeling the pressure. And we have this other, faster-growing business that's spending a ton of cash. So how do these two very different pieces fit together? Well, it all comes down to their big picture plan, something they call the flywheel strategy.
You know what a flywheel is, right? It's that big, heavy wheel that's tough to get going, but once it starts spinning, it builds momentum and just keeps on going. That's the idea here. The huge, stable insurance business provides the cash and, more importantly, the millions of customers. Then, the innovative Carelon business offers all these new services to those customers, which in theory makes the insurance side better and more attractive. Each part is designed to make the other parts stronger, spinning faster and faster.
You can really break it down into 3 simple steps. First, you keep the core insurance business strong and steady. Second, you push all those new services from Carelon out to your millions of existing members. And third, and this is the absolute key to understanding this quarter's numbers, you take the money from both sides and pour it right back into the engine, investing heavily in things like AI, digital health, and all the tech that's going to power the future.
And if you need any more proof, just look at where they're putting their money. This chart tells the whole story. A full 50%, half, of their capital is going toward buying other companies and reinvesting right back into the business. They are making a massive bet on building a completely different kind of company for the future. This is where all those short-term profits are going.
Okay, so let's zoom out. We've gone through the numbers, we get the strategy, but what does all this, the performance of just one company, tell us about the bigger trends that are shaping the entire U.S. healthcare industry? So, after all of that, when you boil it all down, what's the one big idea you should walk away with? What's the real story here?
The big takeaway is this. Elevance Health is in the middle of a massive, expensive transformation. They are knowingly sacrificing short-term profits today because they are trying to pivot from being just a traditional health insurance company into a fully integrated health services company, a company that both pays for your care and, increasingly, provides it.
And you know what? Elevance is not alone in this. This move reflects a huge shift that's happening across the entire industry. It's a move towards something called value-based care. It's a fancy term, but it basically means paying doctors to keep people healthy, not just paying them every time someone gets sick. The future of healthcare isn't just about cutting checks. It's about using technology and data to manage our health more directly. The big multi-billion-dollar question is, will these huge bets pay off? For patients and for investors? Well, that's a story that's still being written. Thanks for digging into this with us.